Bob Dole, our guest host, has just published his top predictions for 2020. Let's run through some of these, Bob. So the first one, you're kind of confident that the current status quo in the economy and globally and in the U.S. can continue.
Yeah, and maybe get a little better, Wilfred. It's overseas where we've been really concerned. Is there going to be a recession, a manufacturing recession? We think those numbers shore up a bit this year and the economy is acceptable.
I mean, if growth does improve, what does that mean for the Fed, for the yield curve? And clearly that's had a huge impact on stocks.
Well, one of our predictions is that inflation and interest rates move up a bit. Not at the Fed level. We think they stay quiet. So we think the curve will steepen a bit more after that inversion scare a few months ago.
So in terms of the inflation, a lot of that is going to be wage pressure.
Bingo.
Imagine. It does seem like it's an emerging theme given the fact that we're at these multi-decade lows in terms of the unemployment rate right now. You expect that to continue?
Yeah, 50-year low. As a portfolio manager, we talk to CEOs all the time, and their complaint is I can't find workers. You know, a year ago it was I can't find skilled workers. Now it's I can't find workers, period. So they have to pluck them away from somebody else, which means they have to raise the wages, and that, I think, eventually has a bit of a nick on profit margins.
Enough to hurt equities? I mean, coming into this year, I guess earnings growth is going to be more important than it was last year when we had multiple expansions.
Hard to see the PE doing its thing again this year, Wilfred. I agree. So the consensus is earnings up 9-10% this year. We're at 5 or 6. That delta's enough if PEs aren't going anywhere to create some disappointment. We think earnings revision activity, which has been negative really for 4 or 5 months now, is probably going to continue.
One of the things that gets my attention here, the Cold Wars within the U.S. and between the U.S. and China continue.
Yeah, obviously a longer-term, almost philosophical kind of prediction. We know the issue. We already talked about China, but this Cold War with China is going to go on for a long time. You know, the two biggest, most powerful economies in the world are going to fight to see who can grow the fastest, who can be number one. Let's hope the world war stays cold and doesn't become hot. Inside the U.S., there are all kinds of cross currents. Generational. Millennials thinking socialism is a better form of economy than capitalism. Suicide rate up big time. Do you know that life expectancy in the United States has fallen 3 years in a row? That does not happen in our collective lifetimes. There's stuff going on that's not real healthy. Suicide rates up a bunch. Alcoholism, drug deaths, et cetera, et cetera.
Not because of some of those final points you just made, but some of the earlier points. Is now the time to put some money to work overseas, European equities, for example?
We think so. You know, some people say people have been calling that for 10 years in a row. We succumbed last year. It was one of the predictions we got wrong last year, but we're putting it up there again between the valuation differential and some catalysts. It's got to be an improved economic growth pattern outside the U.S. If cyclicals do a little better, if the economy is a little better, that tends to help non-U.S. more than the U.S. because the U.S. is the most defensive market on the planet, as you know.